Hey, this is a huge treat for me, so thank you so much for the invitation. So we do this every year. We look ahead for the next 20 years. And at one level, this looks a mad thing to do. How on earth can you look ahead 20 years when you can't even look ahead 20 days at the moment? And so what on earth are you doing? And at one level, as I was saying over lunch, one of the reasons why we do this is even this year, even after the big reductions in our spending, BP will still invest something like $17 billion. It is only in the oil and energy industry that you talk about billions without without a flint of the eye. So those investments will last for 10, 15, 20 years. So having a sense about what the world looks like, where the energy demands are going to be, what the main risks are hugely important. And we produced this document primarily for ourselves, and we produced it about a month ago. We spent quite a lot of time sitting around thinking about the lessons we should learn. And then if we can then go out and then get some feedback on it and contribute to the debate, even better. But we use this primarily for ourselves. And the alternative cases I'll talk about are designed to stress test ourselves. And if other people find it interesting, great. The other thing is, when thinking about what can this do, this outlook, I guess there's two or three things it does. Now, one is that at the moment it's really obvious to identify some big key themes which are likely to impact energy markets over the next 20 years. So it is really obvious to me that renewable energy, wind power, solar power is likely to grow very rapidly over the next 20 years. I think it's almost certain that the growth in the demand for energy in China is likely to slow very sharply over the next 20 years as China economy rebalances. You have these qualitative discussions, but then many people I speak to then look at these qualitative trends and can leap to quite extreme conclusions. Because of the growth of renewables, there won't be a demand for fossil fuels. Because of what's happening in China, the demand for energy will be flat. You need some sort of adding up device just to help you work out what do these qualitative trends look like in terms of quantity things. Now, the underpinning this is embarrassingly simple. There's no great deep sort of micro-founded model here. It's like an adding up machine, but it's an adding up machine to look at these broad trends and just sort of see what they look like. We do that. The other thing we will do by having a forecast like this and an outlook like this, it provides a mechanism for you to systematically look at where you've been wrong in the past, look at those errors, think about what signal they imply for the future, and then make sure you're learning from the past. So you'll see lots of elements of learning in that sort of process. And the third thing is, I was talking again over lunch, it allows you to start thinking about ranges of uncertainty. So this is based around a most likely path, based on our ideas of the most likely path projections for demand, for policy, and for technology. But then we'll look at those and say, well, how can that be wrong? And start looking to using sensitivity analysis to start sketching out the sort of the probability distribution of thinking of forecasts as a probability distribution rather than as a point forecast. So that's what we try and do. In terms of, what I plan to do here is just give you a sort of edited highlights. There's a ton of material in the booklets you have in front of you and a whole range of different things which I won't touch on today, but I'm more than happy to go there. So if you have thick pages and think that looks interesting, I'm more than happy to talk about it. Whatever you do, please, yeah.
So I was actually very curious by what you just said. So I would have thought that the way I would interpret what you did is more bounding analysis, in the sense that you look at what you think is most probable, then the outlying cases.
No, I don't think I have.
You have generated the PDFs of probabilities. Where would they come from?
So I can't do that. I mean, in principle, one can do it. If I had a model, a really deep model, then I could do stochastic simulations to that model, and I can start doing some PDFs. I don't have anything as sophisticated as that. But in principle, one could build up a model.
You said you talked about probability.
Well, okay, so.
What do you mean by that?
So I meant about that the following. So I come from the tradition of forecasting. So at the Bank of England, where I had all my formative years, we had a mantra that forecasts are probability distribution. So do not focus on the probability of the single point estimate ever materializing is zero. So don't think in that world, think of it as a probability distribution. As much as you can, start to sketch out what that looks like, and then do decision making under uncertainty in terms of thinking about resilient portfolios and so on, and think hard about what loss function you want to maximize or minimize, and then think about that. Now, so that's the underlying ideas. This is far, far, far more simplistic in terms of the people I'm communicating with and the apparatus that we are using to get at it. But that's what's driving me, that's what's underpinning my thing. So I'm not doing bounding analysis because when I look at these alternatives, I'm not looking at extreme cases. I'm looking at sort of plausible, what I try and look for is plausible alternative assumptions, which if I say to you, it's this, you'll say, okay, that sounds quite plausible, but it has a big impact. And if it has a plausible outcome which has a big impact, is great, because then it makes you worried if you're part of these people setting $17 billion. So that's the sort of the trick. So in terms of, if I'm doing a model, a forecast for the next 20 years, I need a GDP background as GDP forecast to anchor that. The forecast here is one where GDP on a PPP basis grows at around 3.5% a year. That's just a touch softer than the last 20 years. Some of it's driven by population. The vast majority is driven by productivity growth, particularly in fast-growing emerging economies as they increase capital and adopt best practice technology. So this is a very much a sort of conventional Asian tiger-led story of economic growth, GDP more than doubling over this 20-year period, driven by these productivity gains in fast-growing economies, particularly Asian and China and India. That doubling in GDP causes the demand for energy to increase by around a third over this period of time. That growth is weaker than in the past, so that equates to energy demand growing by around 1.5% over the next 20 years compared to about 2.5% in the past. Sharp deceleration in Chinese energy consumption. Plus also you'll see that within all of the growth in energy demand is coming from outside the OECD. If you look at that green swathe on the left-hand chart here, energy demand within the OECD economies is essentially flat over the next 20 years. Those economies continue to grow, obviously, but at the same time, they're making strides in energy efficiency, which is sort of neutralizing their overall growth for energy. So the story here is one of the material growth of demand for energy over the next 20 years. And the obvious question this raises is, how certain are we this is going to happen? In some spaces, people say, oh, this is just big oil companies talking their own book, saying the demand for energy is always going to keep on rising. What drives energy demand? And the simple answer to that question, again, for a group like this is obvious. What drives that demand for energy is global economic growth. As the world economy expands, you need more energy to power those high levels of activity. You need more energy to power the increase in living standards. Much of this growth is coming from some of the poorest parts of the world, where there's lots of people living in fuel poverty, so you need more energy to lift as they start to be able to lift them outside of fuel poverty. And essentially, plentiful supplies of energy enable that economic growth. And that's what's driving energy demand. The extent to which demand for energy will need to rise is offset by the fact that over this period of time, and we've seen it for a long period of time, we've seen a secular decline in energy intensity of the economy. So if you think of what I mean by energy intensity is the average amount of energy required to produce each unit of GDP. And so what we're seeing here is there's been a secular decline in energy intensity, which limits the extent to which energy needs to rise. And you can see that really clearly in this chart, which just says, look, GDP more than doubles over the next 20 years, but energy demand increases by only a third. And that widening wedge between the two reflects declines in energy intensity. So what's really nice about this chart is it's very obvious. How could this be wrong? How could we get really caught out by energy demand? How could energy demand turn out to be the growth of any global energy demand turn out to be far weaker than we expect? One of two things that can only come about by one of two reasons. One is global GDP growth is a lot weaker than we expect. The red line is less steep. Or declines in energy intensity are far greater, so that wedge just opens up by even more. And obviously, they're the only two things which can cause energy demand to be lower. So we then go and explore that possibility in the outlook and say, well, what could we do? So we explore a case in which China's economic growth is a lot slower than we think is in the base case. So in our base case, we expect China's GDP growth to average around 5% on average over the next 5% a year over the next 20 years, which is pretty much in the pack. I mean, different people have different things. That's a pretty consensus type forecast. What we assume as an alternative is, let's suppose it only averages 3.5% growth over the next 20 years. That means global GDP growth on the PPP basis it now averages less than 3% a year. If you look back in the last 50 or 60 years, that equates to one of the weakest periods of economic growth seen over the last 50 years. So not a bounded solution, not an extreme solution, but pushing it out there. What happens there? Energy demand then slows by around a third. So you get a growth of energy demand by around 25% rather than sort of 35%. Significantly less than what you in the first case, but still a substantial rise. Yeah, I don't know. I wonder if part of this.
There's some macro accounts.
Yeah, I don't have a good answer for that, Michael, because why? What was going on in that period of time? Because some individual countries, I mean, if you look at the UK, for example, in that period of time, you had a huge decline in energy intensity because it was sort of the deindustrialization phase. But then all that was doing was shifting. Sam knows the answer. That's true. So you certainly saw part of that, Sam, would have been a shift away from oil into other fuels, but part of it also was because there was already substitutes for oil, an improvement in energy efficiency as well. Yes, I agree with that. So in terms of how badly wrong could we be on energy intensity, what we've done here, and again the numbers are in the book, we've assumed that the declines in energy intensity over the next 20 years are significantly greater than the average rate of decline we've seen in the past 15 or 20 years. Part of that is sort of the industrialization phase of China has finished, looks like it's coming to an end and coming back down again, which adds which sort of reduces energy intensity. More generally, I think you can just observe, partly post-Paris, but more generally, this sort of worldwide trends towards trying to improve energy efficiency, which will add to this. So we've already built that in already. So if you look at history, the history would say, if anything, you get a less widening, that gap widens by less rather than by more. For energy intensity to fall enough to wipe out any increase in energy demand, you would need energy intensity to be declining by more than twice its average over the last 20 years. It just doesn't seem a sort of plausible number. So punchline from this is, unless the world economy grows far, far more slowly than sort of anybody is predicting, it seems to me almost certain that global demand for energy will rise by a material amount over the next 20 years. Will it be 25% or 35%? I'm not sure, but it's a material amount, and all of that, in emerging economies, the vast majority of that in Asia, and that sort of is a sort of trend number one, what's going on. Please. Yes, so I'll show you a chart towards the end where I assume a very aggressive policy tightening, so where I assume carbon price in sort of the OEC in China goes to $100 per tonne case real, and it goes to sort of $80 per tonne in almost all the advanced major emerging economies. And in that world, that leads part of the story. There's a fuel mix story, but part of it increases energy efficiency story, and that slows it down by about a third. So it goes to 2/3. So I get like a 20% growth rate story in that story rather than a 30% number. But again, the confidence bands here are enormous, obviously, but it's sort of just looking at rough rules of thumb, and sort of, which is what this is doing. It gives you some, and the shifts in the energy mix are really profound, and I'll come on to look at that. But you're still getting a sizable increase in energy demand over that period. In terms of what does the fuel mix look like? So in our central case, energy demand is increasing by a third. What does that look like in terms of the fuels meeting that? The chart on the left here is in shares of primary energy, and it's because it's a share, it's relatively slow moving, so you can't see the sort of the speed of the growth rates which are happening. But just to give you a pattern of what's going on here. Fossil fuels remain a dominant source of energy, which is not a surprising thing. So they provide about 60% of the increase in energy required over this period of time, and are providing around 80% of the world's energy needs by 2035. That compares to about 86% today. So a decline in the role of fossil fuels, but not a dramatic one. Natural gas is the world's fastest growing fossil fuel, and natural gas is being helped by two things. One is just enormous supplies of natural gas, and I'll show you some charts on shale gas at the moment, but there's just those supplies, ready supplies of natural gas, just means gas is likely to remain pretty cheap over this period of time, which allows it to compete. Also built into this story is the assumption that you'll get gradually tightening environmental policies, which will help gas as well as renewable energy gain share relative to coal. Oil grows steadily, nowhere near as strongly as gas, but it grows in sort of, for those who like to think in sort of just in terms of barrels, it grows by about 20 million barrels a day over the next 20 years, so about 1 million barrels a day growth, which is for a market which starts about 90. So it's about a million barrels of 1% a day type a year story. What drives that? All of that demand for oil is coming from outside the OECD. OECD has been consumption of oil has been declining for the last 10 years and is likely to carry on declining. And the very big chunk of the growth of oil demand is coming from fast-growing Asian economies. As they become richer, their income per capita picks up. There's a sort of standard S-curve you can look at in terms of income per capita and vehicle ownership. Even if you push down on that S-curve and make it sort of extract it out and make it longer to reflect the fact that perhaps vehicle ownership may be less intense in some of these economies, that still gets you the number of vehicles outside the OECD tripling over the next 20 years, from about 500 million vehicles to about 1.5 billion vehicles. Those vehicles become far more efficient over time, but despite that, you still get an increase in the demand for oil. The big caveat here is what's happening to electricity in terms of its penetration in the transport sector, either by plug-in hybrids or pure electric vehicles. BP produces a sister document to this called the Technology Outlook, where our technology experts look ahead and how they think technology is likely to evolve. Their story on electric cars is it's a when, not if story. So battery technology is improving, it is coming down. It will increasingly allow electricity-based plug-ins or pure vehicles to compete against internal combustion engine. But the pace at which that is happening means much of that is likely to happen off the page in terms of 2035. And so we don't have a significant penetration of electricity in this forecast. But when you've only got a 3 or 4% penetration, it's pretty obvious which way the risks are skewed. And so, if we were in a world where you saw a far quicker penetration of electric vehicles, I think the impact that would have is to have a big impact on the fuel mix in terms of oil versus other types of fuels. I'm not sure it'd have a huge impact on overall demand for energy because I'm already building in huge improvements in vehicle efficiency here. An average vehicle today on the planet does, in rough numbers, about 30 miles per gallon. and under our assumptions, by 2035, it will do 50 miles per gallon. So very significant improvements in vehicle efficiency, and that pace of improvement far quicker than we've seen over the last 20 years, a big significant increase. Interestingly, what it will do for carbon emissions if we move to electric vehicles is unclear at the moment, and it could well, in many parts of the world, increase carbon emissions rather than reduce carbon emissions, depending on how that electricity is produced. Obviously here, everybody nods. It's quite amazing how many conversations I have where people think electricity is just produced by walls when it comes out when you plug it in, and they forget you actually need to actually think about what fuels are used to do that. You'll be surprised at the conversations I have. But that's a big caveat on that. Coal is slowing very sharply. So coal over the last 20 years has grown around 3% or so. We've got it growing at 0.5% going forward. Nearly all of that slowing is a China story. And I'm going to come on and talk a little bit more about China. But for the last 10 or 15 years, essentially coal has been China. All of those trends are a China story. And so understanding how China could react is key to that. And I'll talk about that. Renewables here in the orange line is a sort of the fastest growing fossil fuel. So for renewables here, I take out hydro for no deep reason other than the fact that that's the classification we use in BP. So renewables here is essentially wind, solar and biofuels is what's doing the work. That's growing on an average growth rate of over 6.5% over this period of time. It's as a result of which its level more than quadruples, almost quadruples over this 20 years, and its share in energy goes from 3% to 9%. This is one of those qualitative, quantitative things we were talking about earlier. Enormous growth in renewables, huge growth as we go down that learning curve and are able to compete. By 2035, we're assuming that they're able to compete across much of the world without any form of subsidies, almost quadrupling. But their share only goes from 3% to 9%, so providing less than 10% of the world's energy needs. So these people that stand up and say renewables can just solve the world's energy needs, not in any sort of arithmetic model life can look at.
Is it increasing gas? I can't
So gas is growing by about 2% a year. So it's sort of going by 40% over this period. Its share's rising because overall energy demands have grown by 1.5. So that's a fairly significant growth for a fossil fuel, but tiny compared to for renewables. But obviously there's a size matters type story here. Given the time, what I wanted to do, rather than going through bit by bit, I wanted to sort of pick 4 topics which I think are quite interesting, which are coming out of the energy outlook as a way of sort of provoking the debate. So what have we learnt about the US shale and how could shale change things? China's changing energy needs, what's going on there? How to think about renewables and non-fossil fuels and the types of errors we've made in the past and what signal we should draw from those errors in the future. And then finally, which is the right place to do this, in sort of the changing outlook for carbon and what carbon emissions and what does our world look like for that. This first chart shows forecasts for US tight oil and shale gas on the left and the right-hand side from our last 3 or 4 forecasts. And I can only take our forecast back out of interest to 2013. And so the reason why I can only take it back to 2013, before 2013, we didn't produce separate forecasts for tight oil and shale gas, which in itself should cause us just to pause and reflect on just how recent a phenomena the shale revolution is. So we used to produce these forecasts and we go around and talk to people, and we just didn't think about separately identifying because it just wasn't important enough. A matter of 3 or 4 years ago. The other point that comes out of this chart is we've been repeatedly surprised by the strength of the shale revolution. We've repeatedly, both the technological innovation and productivity gains have means that the shale revolution has grown. The prospects for both tight oil and shale gas we've systematically revised up those forecasts. It may seem odd in the current environment what's going on in shale now that we've revised up our forecast for tight oil even more this year. So clearly what's going on now is we've seen a very significant reduction in in number of rigs operating in US Territorial at the moment, it's down 70%. Production levels are down about 500,000 barrels a day already and are likely to carry on falling. But the underlying economics of US Territorial still looks really significant. The intuition to think about why does that curve start to plateau out over towards the end for tight oil is because there's a resource-based constraint for tight oil, for US tight oil. And so you're starting to hit that resource constraint. And so we don't have it coming up and down. We sort of have an assumption that you go up and then it sort of plateaus out at that level. So why have we revised up so much? These productivity gains, two things are going on. One is these productivity gains are just meaning that more and more resource bases are available. We've also seen some quite significant increases in recovery factors in terms of what you can get from these wells. So I'd never really understood what even a recovery factor was until 18 months ago, because I wasn't an energy guy. So for those of you who are more economists and less an energy guys, so the recovery factor is how much within a well can you recover. And I think that for a conventional well, the numbers are like 25-30% of the oil. Up till now, initially from a shale well, the numbers were like a 5% number. Interestingly now, people now talk about like a 5 to 10% number. There are some people who talk about sweet plays where you can be like a 12% number. I spoke to our head of exploration working in shale, and I said, if I said 25% in 5 years' time, would you say I was mad? And he said, no, I think you'd be pessimistic. Remember, when you've got if those recovery rates are going from 5 to 10, that's suddenly doubling the resource base. And so suddenly that constraint is being relaxed, and that's what's the intuition for why that green line is going. But there's a huge uncertainty if that recovery rate, and we built in some further increases in recovery rates, but if we get that wrong, that could be significantly greater. But remember, if you get anywhere close to a normal conventional well of 25-30, that's a game changer. Shale gas is different in the sense that the resource base for shale gas is not going to be a constraint over the next 20 years. It's huge. And it's huge, and people can make money. People are making, even with natural gas prices low now, in those key shale gas plays, they're still making significant returns today. And as a result of which, we've got shale gas growing very strongly. It's growing by sort of about 4% on average per year over the next 20 years. That means by 2035, it accounts around 3/4 of US's total gas production, and it counts around 20% of the world's natural gas supplies. So shale gas, US shale gas, is a game-changing type phenomena. Again, in the outlook, so we think, well, how could we be wrong here? We think we've learned the lesson from the past, but if I see a series of errors like that, I worry that I haven't learnt my lesson enough. And so we explore an alternative case where we get a stronger growth of shale, both in the US and the rest of the world. Michael was talking about afterwards about what about the rest of the world, and does it start to roll out? It starts to roll out towards the end of this outlook. So in the last 10 years, around half of the increments in both tight oil and shale gas come from outside of North America. China, Russia, Argentina, some of the key countries where we expect it to come out. What could it conceivably look like? For tight oil, I think you could, in that case, it gets to about 20 million barrels a day. So it's about 20% of the market. Huge impact in terms of dynamics, but it's not wiping out all of other types of conventional production. It's a 20 million barrels a day in a 110 million barrel market, even under that other case. And for shale gas, it's starting to get this to about 35% of the market. So shale gas is a far bigger deal. Interestingly, the economics are very different under those two cases. For oil, the big key issues here is how much of the oil crowds out conventional production, and how does OPEC respond to that? And how much of it, by lowering the price, will it just generate the demand to match for it? For gas, because of the way it can compete in the power sector, you have those arguments, plus you also have the arguments of how much share can the gas take from renewables and coal. And so you have a different type of sort of problem to think through, and we try and discuss some of that in the book. So the prospects for tight oil and shale gas, despite the sort of retrenchment we're going through now, significant over the next 20 years. No, they've come down very significantly. So they are more like, I'm looking for how many, about $7 or $8 MMBTU. So yeah, so we have. So again, I'm going to be a little bit candid, especially if I'm in terms of prices, especially if I'm going to go on the internet on this. We have prices within US shale gas coming up a little bit from where they are now, but not getting anywhere, but staying pretty low. And then ultimately we move into a world of sort of an arbitrage relationship across the whole of the gas markets, because so if you took full cost of additional liquefied natural gas plus the transportation costs, you're starting to get that sort of an arbitrage relationship. And you could get full cost LNG with transport costs could add you about $4 onto a Henry Hub price here. And I won't have time to talk about it today, but another feature which we talk about in the book is this growth of liquefied natural gas, which will become the dominant form of traded gas over the next 20 years. I hate economists when they make statements like will do. Half of that growth I expect to see happens in the next 5 years, and I know that will happen because it's not based on a regression. It's based on sitting down with the accountants, adding up all the projects which I know have been started, and I can just see it happening. But what's special about LNG? It can respond to price signals in a way that pipelines can't, and so suddenly these regionally segmented markets up to now will now suddenly be joined together by this LNG like a glue. If they start moving away, the LNG will bring them back together again. And so I'll have regional gas markets moving up and down together. So I move into a world of a global gas market as well as a global oil market in terms of this LNG. So really radical changes in sort of gas pricing dynamics we expect to see over this period. We can talk some more about that if people would like. Yes, please. For gas, I think it's based largely on the fact of in some of these the sort of the Marcellus region and Utica regions, they just look at the size, and there's Haynesville as well, these three enormous resource bases, just the amount of the gas they can observe there now and the amount of what they can get it out the ground for now would allow me to do this. And I have built in further productivity gains as well, but I don't need to have sort of extraordinary productivity gains built into on the gas side just because the size of the resource base is already there. Just for those who are not familiar with the numbers, the productivity gains in tight oil are truly mind-boggling, what we've seen over the last 6 or 7 years. So if you measure productivity gains in the initial production of a rig operating in tight oil, initial production per month, so how many wells can it drill and how productive are those wells, but based on the initial production. Productivity gains have averaged over 30%, 30, for the last 7 years, each year for the last 7 years. Unbelievable productivity gains. It's just game changed the world we live, because these productivity gains are just enormous. And you go speak to people, and intuitively, why are we achieving such amazing feats as this? Is because it's manufacturing. We've moved from engineering to manufacturing, and you're repeating processes over and over and over again. And we know when you repeat processes over and over and over again, you get a lot better at them. Or put another way, there were something like 50,000 wells drilled in 2014. 40,000 of them were drilled in shale, which only presented 5% of the market. So you're just doing this enormous repeated process, which is driving these amazing productivity gains through, rather than the big conventional oil, which each one crudely is a bit sort of like a bespoke one-off operation, and so you just don't get those sort of productivity gains in conventional oil. And one of the fascinating issues, I think, is can you take some of these learnings from shale and start applying it to conventional oil in terms of standardization, lean manufacturing things, less engineering, more manufacturing, I think is an active conversation that many energy companies are having at the moment. Well, interestingly, productivity in conventional oil is sort of a conversation which didn't happen. Because it's quite a hard thing to think about what productivity means, because nearly every project is a one-off project. And so it's hard to actually, they just don't, up till now, they haven't had conversations about productivity and margins very often it's talked about acreage and getting access to that supply and thinking, can I make money out of it? But it's just been a different way of thinking. And I think one of the things about shale is introduced a whole new language and a whole new sort of business frame of reference, which I'm sort of encouraging people internally to think, well, let's think about taking those learnings. So one way of doing this would be, so I used to have a team of economists, so this is a story to tell. At the Bank of England, I had the army of economists, and every time a question came up, a new question from the policy committee came up, they would say, let me build a model to think about it. And I go, well, why are we building a new model to think about it? Why don't we just use one of the ones we've been producing over the last 3 years and just use that model? Well, it's not perfect to answer it. It's not quite the right model, but it may be good enough. And that way we can answer it today rather than wait for 3 months. No, I'm going to build a new model to do it. That's sort of what engineers behave like as well, as my experience is, can I use the existing, can I use one of these existing platforms? No, I need to do the perfect platform to do this. Well, why don't we use an existing one, which may get 80% of the oil out for 50% of the cost? That may be good economics, but it's not the way we thought of up to now. Engineers have said, great, and I can do another new one. And perhaps some of this thing, what does this look like? It's increased standardization, increased good enough, rather than optimal engineering. China and what's going on in China. So again, obvious for this group, China really matters for energy. China's the world's largest market for energy. It consumes more than almost a quarter of the world's energy it produces. When you think about energy, I say this and somebody should correct me if they're wrong. It seems to me when you're talking about energy, PPP is a way to measure economy sizes, not market exchange rates. So that you want to think about demand for resources. And when you think about demand for resources, it's a PPP concept. China is already the world's biggest economy for this type of stuff. It consumes almost a quarter of the world's energy. Over the last 10 years, China provided 60% of the increase in the world's demand for energy. Right? So this is the biggest, fastest growing market, and its demand for energy is likely to change very dramatically over the next 20 years. And with it, that will reverberate through global energy markets. And so a very simple chart here, just showing you that we expect the China's demand for energy to slow by and to be about a quarter of its growth rate seen over the last 20 years. So in the past, it's grown about 8% a year on average. We expect it to grow by around 2% a year on average over the next 20 years. Some of that is a GDP story, so we expect the GDP growth rate to slow by about half. On average, in the past, it's been doing by around 10% a year. We expect it to grow by about 5% a year. So GDP grows by a half, but energy demand by a quarter. So why is it growing disproportionately more? Some of that's an energy efficiency story, but a big part of it is a changing structure of the Chinese economy. The Chinese economy is going through its sort of post-industrialization phase. Up till now, much of that growth has been driven in heavy industrial sector growth, which is highly energy intensive. What we're seeing is the pattern of growth shift over time to an economy which is more towards domestic absorption, supporting that increased wealth, increasing service sector growth, increase consumer-facing growth, which is far less energy intensive. And that's also a really important pattern going on here. The fuel which gets hurt the most in China is coal, because on top of all those forces, there's a further force, which is this huge pressure and environmental policies for people to switch away from coal into cleaner, lower carbon intensive fuels. And so in our story, we have extraordinarily strong growth in China, in renewables, in gas, in nuclear energy, getting this shift in the coal mix from around 2/3 of China's China's energy is provided by coal at the moment, to around 50%, just shy of 50% by 2035. So a huge shift in the fuel mix. One of the privileges of this, yeah.
Can I just ask about the pressure on coal? In principle, what China could do is do what happened in the States, which is to go to clean coal, in quotes, where the major pollutant ends up being just CO2. You get rid of the precipitators.
Yeah, absolutely.
You get rid of NOx, SOx, and particulates. So why wouldn't they do that?
Which is absolutely a right question. So the naive answer, which I think is sort of true as well, is I think they take their role in terms of global climate seriously. I know that sounds ridiculously naive. One of the privileges I have in this job is I travel around the world an awful lot. The most striking conversations I've had anywhere in the world, in any capital and any subject, is the commitment that China seems to be having in terms of doing something about climate and environmental issues together. You sit in capitals in Europe and they rub their hands and say, we must do something about cap and trade, but it's really difficult. We'll try and do something. China, they're just doing it. And they are doing it, and they're driving through enormous programs. I mean, again, people here will know more. To achieve that reduction in coal, you need to grow all these other energies hugely quickly. So China's nuclear energy program, is equivalent to them introducing a new nuclear reactor every 3 months for the next 20 years. So in the UK, we just went through a 3-year parliamentary commission to introduce one nuclear reactor in Hinkley. Right? This is a new nuclear reactor every 3 months for the next 20 years to get, and then you need similar programs for renewables, similar programs for gas. And remember, not implicitly, explicitly, this is effectively a tax on growth. Why is coal there? Because it's cheap. And so if I'm moving away, it's a tax on growth. And I'm trying to do that at the same time as I'm trying to reform my state-owned enterprises. At the same time, I'm trying to liberalise my financial system. At the same time, I'm trying to liberalise my capital account system. So where are the risks here? My hunch is the risks here are to the upside for coal, because it's a big ask. And it conflicts with everything else they're trying to do. But it feels very palpable when you go there, the determination to do it. In terms of the most recent 5-year plan, I think they have the share coming down to below 60% over the next 5 years in terms of the 5-year plan. Whether we achieve that or not is unclear. I think they have been successful in terms of renewables. They have been successful in some of their nuclear. They have not been successful in the last 2 years in terms of gas. They can't get the pricing of gas right, and so at the moment gas keeps full starting, and so there's risks around that. But in some sense, China's energy needs are changing very dramatically. I think this is a direction of travel. Exactly what it will look like, well, obviously, is a function of all those other things. But whatever way it does, it will reverberate around the whole of global energy markets because it's so big and so important. This next one, I just want to look at renewables. So, about a year ago, there was quite a famous study in social media and stuff, which showed that the IEA had underestimated the growth of renewable energy for every year for the last 5 or 6 years, or even for longer. And our chart on the left here shows that, guess what, we did exactly the same, and we underestimated that. I told my boss I was going to put this in the booklet, and he was going, why on earth are you doing this, Spencer? Why are you telling everybody all the errors you make? And I was trying to explain to him, but that's how you learn from your mistakes. And so, guess what? We've made exactly the same errors on renewable energy. The growth rate, the pace at which costs in renewable energy have come down have been quicker than we expected. The rates of deployment have also been quicker than we expected. I'm being told I'm talking for too long. I've had questions, so it's okay. And so we have been, so we've revised up consistently. What I found interesting, though, is that those upward revisions to renewables have not led to an upward revision in overall non-fossil fuels since 2011, shown in the chart on the right. Sure, we got renewables wrong, which is shown by the upward revision in those orange bars, but that's been offset by the downward revisions to nuclear energy post-Fukushima and to biofuels, where the sort of technological advancements on advanced biofuels have been less than we expected. And so the moral I took from this is you can make two-sided errors on non-fossil fuels as well as fossil fuels. You don't just underestimate the growth of non-fossil fuels. Things can happen, either policy or technology, which means you can overestimate the growth of non-fossil fuels as well as underestimate them. So, there's both sides here. What time do I need to finish by? Are we? What time do I need to? 1:45. I need to finish this for Q&A or go. I can't remember what I'm supposed to be doing. Oh, I talked for too long, didn't I? Okay, so let me, all right, that's why Armelle was shouting, watch, thanks for carbon emissions, 3 points on carbon emissions, and then I will stop. One is, the outlook for carbon emissions looks like it's getting a lot better. So we expect the growth rate of carbon emissions to more than half over the next 20 years compared to the last 20 years. This chart just sort of looks at two parallel periods. Why? Because we expect carbon intensity to decline by far more, plus we also energy intensity decline by far more. We also expect an improvement in carbon intensity, the amount of energy emitted per unit of energy to be less because of this shift in the fuel mix. So 1% growth rather than over 2% growth. Good news. Bad news, it's 1% growth, which means over 20 years it's grown by 20%. The IEA 450 scenario means it to fall by 30% over that period. So you've got a huge gap here based on our view of the most likely path for policy. Moral central message from this is we need more policy intervention.
Your base case has some policy built in.
It's our best guess of policy over the next 20 years. It doesn't assume policy here. It's our best guess of how we think policy will evolve over that. Tightening environmental policies, improving vehicle efficiency standards, all of those things built into this, and you get to that story. So our central message here is more needs to be done, and if you've been amazed if I'd said anything else. The right way of doing that is putting a price on carbon to generate improvements on both sides. The third thing we did is say, well, what would the world look like if we had a faster transition to a lower carbon environment? So we looked at a case where it falls by around 10%. And how we achieved that is we sort of looked at a whole range of measures which we thought were feasible within the current policy regime and were feasible within the sort of current technology. So I've got carbon pricing rising to $100 real by 2035 in the OECD in China, and by sort of $80 in most of the major emerging economies. Huge improvements in vehicle standards and legislation, significant improvements in efficiency standards in buildings and industry. For those familiar with the IEA's sort of optimal efficiency scenario, I'm assuming I get 80% of those gains in industry and building. So real big kick. And I get down to, I get sort of halfway between. It wasn't designed to be halfway, just so I can bend, I can get that trend bending, I can get it down to 10. Yeah, and by design here, I just hold GDP constant. I don't try and think about those feedbacks. I just, partly, I don't want to enter that debate in BP, and partly, I just do not have the sophistication of the tools to allow me to enter that debate. So for both reasons, I don't. What does that world look like? Just quickly, coal gets absolutely crushed. And why does coal get crushed? Because it loses out in the power sector by that carbon price. The power sector is great. It's like 50% of the world's or 45% of the world's energy compete there, and they compete side by side. So relative prices really matter. And so carbon pricing can do a lot. Renewables growing enormously, but still, even with this enormous growth in renewables, it only gets to 15%. You see that peak demand in oil in the green line there. Oil overall still grows over 20 years but starts to peak off. But gas and oil together still do grow in this scenario, even with this sort of far more aggressive policy regime underpinning it. I will now, otherwise Valerie will tell me off and go. And well, even worse than that, I will miss my plane home, which would be a bit of a bummer. Let me stop there. We've got time for one or two questions, and then we should stop. Sorry for going on for too long.